Hello, everybody. So today I want to talk about two stocks that reported their earnings. The first one was this morning. Inmode reported its earnings. As you know, I have a small position in Inmode. Inmode specializes in these minimally invasive aesthetic procedures. So not quite cosmetic surgery, but better and light laser/looks procedure. They sell these machines to doctors and other types of offices that specialize in these light procedures. These machines are, between 70 and 100 grand per machine. That's the main business model. And over time, this is a business that should see the share of supplies really grow compared to the cost of the machines. Given that these machines cost this much money, like 70, 80 grand, this is a business that has been hurting with the current interest rate environment, because we know that these aesthetic offices, borrow money typically to buy these products. They borrow money at 10, 11%, and the $70,000 at this price, it kind of hurts your sell. And so this is a company Inmode that I like very much, because obviously it's extremely cheap compared to what it used to cost back in 2021 and 2020, and they are building. They are actively expanding. They launched in 2023 two new platforms, two new machines. They have two new machines again coming up in 2024. They are hiring more sales staff. They're focusing on growing their sales internationally, in the US as well, but with a greater focus on international. They are exhibiting pricing power. They're defending their gross margin at an outstanding 84% gross margin on these machines, on these 70K machines, 84%. Think about that margin. It's pretty stunning. And revenue, of course, in 2023, with the interest rate environment that we had, that revenue only grew at 8%, which is not that good. But the stock is so cheap, it more than makes up for that. In my view, this is a stock that I want to own for when the growth comes back. I want to be already into this stock for when the growth comes back. When I look at my usual metric, you can see that my metric heavily punishes company that don't have too much growth. And this is a company that's only predicted to grow at 12% over the next 12 months. And as a result of that, I still get in the top tier cheapest stock in my universe at a 0.23. It's still the top tier cheapest, but it's not nearly as cheap as, say, a company like Hims or StoneCo, a company that has a lot of growth. This company doesn't have growth. Imagine if this company were growing back at 50% like it used to be. This would be the cheapest stock in the world. It's not there yet. But what this company is going for is it's highly profitable at 41% EBITDA margin. So as I like to joke, this is this type of company, when you look at the way it's set up, it's in the cash piling business. They are piling cash at this moment because we are defending that margin, and it's a rule of 40, past a rule of 40 at a 53. And again, if we were growing at 40, 50%, you'd have a rule of 80, rule of 90 easily. Some of the things that they're doing to grow their sales right now is and they were working on that the past quarter, but they're still working on working with channel partners on financing and customer financing. And they're actually thinking about taking on some financing themselves in order to move those machines. Financing seems to be the key point as to why doctors are not acquiring these machines right now. Interest rates are so high. The company has $700 million of cash and no debt, so why not provide incentives in the form of helping out with the financing? When interest rates inevitably drop, not rise, drop, when they drop, in my view, patients and doctors will get back into those cosmetic procedures, those procedures that are more discretionary in nature. This is what happens when the economy is booming. People don't hesitate to spend, $5,000 on some belly size reduction. You see how right now it's not really what's going on, but that's why the stock is cheap, right? That's why the stock is cheap. Cosmetic surgery, it's a very, very old industry. I would argue it's at least 40-year-old in a meaningful sense. It's much longer than that if you don't mean in a more meaningful sense, but people have been interested in cosmetics and looks as far back as the Egyptians. So this is not something that is going away, in my view. Inmode, my conclusion for these earnings is they are on track, they are building, that's what they are doing. This is a stock that is yet again hurt by our current stock market, which is so annoying, so boring, which is the whole idea. It's a single issue stock market. All the market cares about is interest rates. Look at a day like today. Fundamentals didn't matter today. Your company is working really hard. Your employees are working so hard. Your engineers are doing something amazing. The market doesn't care. All the market cares about is how an old man is going to interpret the CPI. That's literally, I mean, how many, oh my gosh, how many months of time are we wasting just discussing how some old man interprets the CPI? Like, it's so intellectually mind-numbing. I can't even take how intellectually mind-numbing this is. Anyway, so now the probabilities for a rate cut are saying in June. All this is doing, by the way, in my view, this means that we're going to have greater rate cuts towards the end of the year if we are waiting until June for a rate cut. We still have more time to accumulate. Keep in mind, this interest rate situation will pass. These too shall pass. Remember in 2020, people thought the world was never going to be the same. Turns out we're back. We're back to normal. This too shall pass. These interest rates... Today was an annoying day. Anyways, let me move on to Robinhood. So Robinhood, and by the way, Inmode was down 10%. So let's go on Robinhood. So Robinhood, the call should be starting about right now. Any minute it should be starting. But anyways, we have the presentation, the shareholder presentation. So Robinhood is doing very well. Their assets under custody, and we have the IRA deal that they have, the 3% cashback deal that they have until April. We should thank them. We should thank that deal for that. Their assets under custody are up 19% sequentially, $103 billion. Not bad for an app that's supposedly just for Gen Z, right? Not bad at all, $103 billion. These Gen Zs will age at some point, and that will be their Schwab or their Fidelity. I think Robinhood will be the Schwab or the Fidelity of Gen Z, as the Gen Z is inevitably make money and inevitably go into the real world and go get a job, etc., 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 etc. And many of them already do have jobs. Deposits are growing 27%. Gold subscribers, they're growing steadily, right, from 5% to 6.1% in a year and a half, 2 years. Is it going to be a tripling from here? I think it's an easy tripling because their gold subscription is very interesting. If you do any sort of active trading, any sort of margin, and with their credit card that's coming up, that's going to be more and more appealing to a lot of people. So we see a lot of growth everywhere, but in the revenue. The revenue is not growing too much, but this is a company who captures customers earlier on in the funnel. You have to catch the customers in the funnel, and it is after that these customers turn into revenue. That's why we talk about cohorts, right? A cohort, year one of the cohort is not going to make that much money. 7 years, 8 years in the cohort is when the money comes. So you have to acquire the customer before you acquire the revenue. When I look at the valuation, of course, my metric obviously does not favor companies that have very, very little growth. And this is a company right now which is also in building mode, predicted to grow by analysts at only 5% over the next 12 months. So that looks like an expensive company on my traditional EV over GP over revenue growth. But keep in mind, this is also a company that is making quite a bit of cash. In fact, we surprised the market today with profitability. You know, on this channel, I care more about, I believe, the more accurate metric, which is EBITDA. Much prefer EBITDA. I think it's a much better representation and stable representation over time of the company's ability to make money. Their EBITDA margin was 28%. So that's quite a bit. And you're nearing a rule of 40. This is a type of company that I believe one invests based on qualitative analysis, first and foremost, qualitative analysis, as opposed to just looking at the number. When you look at this company qualitatively, you realize that this is a company that has aura all across Europe, not just in the US. They are entering in the United Kingdom. They are entering in Europe. The Robinhood movie, the Dumb Money movie, was very popular in Europe. It's not just popular in the US. This company is the symbol of an investing generation, and they are leveraging that brand going internationally, and I believe they're going to be doing very well for that. They're also introducing interesting products, interesting market that are of interest to active traders and to really more money savvy people, like 24-hour markets. That's really nice that you can buy stocks after hours. I mean, it's about time. It's about time that we have markets that trade all the time. We don't live in a world where someone has to be present in the stock exchange from 9 to 5 anymore. And innovation continues. And I'll conclude with this video with their 3% match. If you can see, their assets under management for retirement are going up through the roof. And that is why. That is because of that 3% match. Think about that. If you have an IRA, you have $1 million in your IRA, you transfer your IRA to Robinhood. Robinhood gives you $30,000. $30,000 if you transfer $1 million, right? $3,000 if you transfer $100,000. I did it on my IRAs. In my view, this is a no-brainer, and they're going to keep gaining customers at least until April when they have this promo running, and we'll see if they run it again. You know, these companies, when they have a successful promo, they can run it again. They are building their retirement business, and of course, retirement business is great because you acquire customers for the very long term whenever you sell a retirement product. Just ask Fidelity, just ask Schwab, just ask Vanguard. That's what you do. This is a business that is getting set up for the long term, and I'm very happy to own it. The stock is up 9% right now, and I think it is well deserved. So, this was not investment advice. This is just entertainment. I'm hoping you were entertained. Please like, please subscribe. Thank you for watching, and have a wonderful day.